Hi everybody, in this example, in this chapter, we are going to go over stocks and their valuations. What we did so far was we kind of wrapped the accounting accounting informations through from chapters 1, 2, 3, and 4. In chapter 5, we look at time value of money operations, and then in chapter 6, we started looking at trying to calculate the interest rate for bonds. In chapter 7, we evaluated bonds. In chapter 8, we looked at trying to calculate the quote-unquote interest rate or the required rate of return for stocks. Now it's time to do the valuation of stocks. Now, what we are after basically is we are trying to calculate the intrinsic value or the true value of the stock. Now, that is pretty much the holy grail. That's what everybody is after to. If someone can find if the stock is undervalued or overvalued, then that person will determine whether to buy or sell a specific stock. Now again, the key is to find the intrinsic value because market prices are given. You can find them daily. Finding the intrinsic value is the difficult part, and we are going to see there are different ways, academic ways, to calculate the value of the stock. It has a lot of assumptions, and your models are as good, or the price that you are finding are as good as your assumptions. So with that caveat, let's take a look at these some ways. Dividend discount model is basically what it's telling is we are going to do time value of money operations. We are going to say dividends are cash flows. The stock price we are paying today is the present value, and I'm going to calculate it based on time value of money operations with the interest rate that we have calculated from chapter 8. Corporate valuation model is very similar. Time value of money operations, what we are doing is, okay, what is the cash flows that is going to a specific firm? What is the weighted average cost of capital to the firm, which is a weighted average between debt and the stock? And I'm going to calculate the present value using time value of money operations. PE multiple approach is something easier. You can do it literally at the back of the envelope. What you do there is you calculate the price based on an average given in an industry, PE ratio. Let's say PE ratio in a given industry is 10, and earnings for a specific firm you are considering is $2 per share. That means 10 times 2, you roughly need to pay $20. Again, back of the envelope piece, and it's giving you a kind of directional method. It's not super scientific or gives you the exact value. It gives you the ballpark. And we'll also talk about economic value add approach. Now, the first one, as I mentioned, was dividend discount model. And the idea is the price that you need to pay today is pretty much all the dividends discounted back with whatever the discount rate for that stock is. Remember, this is something we calculated from chapter 8. And you discount them and you find the present value. This is the idea behind dividend discount model. Now, obviously, it goes to, if you look at it, it goes to infinity. You cannot calculate dividends until infinity. You cannot add infinitely many numbers. So you need to make certain assumptions that will make your life easier. One assumption is constant growth. What you are saying is the dividends will grow at a constant rate G. If you do that assumption, then doing some arithmetic here, your formula here reduces to pretty much this. The dividend in a year from now divided by required rate of return minus growth rate. It reduces to that, and it can show mathematically. I don't need you to kind of derive the formula, but you need to understand that there is, in order to reduce it to a simple formula like this, there is a big assumption there where the company grows at G% constantly, indefinitely. It's a big assumption. It makes the formula very easy. Now, you might ask, if you look at the formula, what happens if G is greater than R? Constant growth formula leads to a negative stock price. It doesn't make sense. Constant growth formula can only be used when growth is less than the required rate of return or stock, and it's almost always the case that required rate of return is greater than growth, because growth usually is around 2%, 1.5, so on. So around those, where required rates are in double digits, 10%, 15%, 20%. Now, if you are given that, for example, the risk-free rate is 7%, historically market return was 12, and the beta of the stock was 1.2, what is the required rate of return on the stock? This goes back to chapter 8. This slide is specifically chapter 8. So you take 7%, you take market minus the risk-free rate, which is 5%, multiplied by 1.2, you are going to get 13%. Based on CAPM, one way of calculating the required rate of return on the stock, you get 13% discount rate. And let's further assume that again the discount rate is 13%. The current dividends is $2 and G is constant at 6%. Let's calculate the value of the stock. So D1, which is going to be the dividend a year from now, is going to be $2 multiplied by 1.06. Why? Because it's growing at 6%. So 2 multiplied by 1.06 is what's being done here to get the 2.12. RS, we calculated it based on the CAPM assumptions, 13%. Growth is 6%. Based on that, the price of the stock turns out to be $30. The price in a year from now, you can calculate that as well. What you need to do is take D2 and shift it and say, you know, the price of the stock is going to be $32 instead of $30. It's kind of growing at 6% basically. Now, some key terminology. The dividend yield is what you are getting from dividends. So when you invest in a stock, you expect to get two forms of cash flows or gains. One is through dividends, and the other one is through capital gains. And if you calculate it, the total return is going to be what is expected. We expected 13% return, and it's in this particular case, it is divided by 7% dividend yield you're getting, and 6% is capital gains yield. If there is no growth, if G is 0, what you need to do is pretty much, okay, the dividends are going to be 2 indefinitely, and you divide it by 13%, as if this is a perpetuity, and you find that the price of the stock in that case, if there is no growth, is going to be $15 as opposed to 30, which makes sense. You are willing to pay more if you are expecting a growth, like $30 in the previous example, and you are willing to pay less if you don't expect any growth. The next piece I want to cover is corporate valuation model, where you calculate free cash flows to the firm, which is earnings before interest and taxes multiplied by 1 minus the tax rate, plus the non-cash charges, depreciation and amortization, minus the cash flow for operations and capital expenditures, the net change in net operating working capital and capital expenditures. So this is the cash flow that you are investing into a firm. And what you are finding is the market value of the firm. If you subtract from the market value the debt of the firm, and if there's preferred stock, you subtract that, then you find the market value of the common stock. This is another way to calculate. This is an alternative to dividend discount model that we discussed. An alternative way, basically calculate the free cash flows to the firm, discount them using time value of money operations. And the discount rate here is important. It's weighted average cost of capital. And subtract debt, you are going to find common stock. Now, you need to get the weighted average cost of capital. I will either give it to you or you need to calculate it. I'm going to give an overview of weighted average cost of capital after the midterm. But what you need to know for now is pretty much that. Aside from that, as I mentioned, there are two other methods I want to mention briefly. You can use some standard ratios that are, you take the averages of PE ratios or price to cash flow ratios or price to sales and multiply it with the, in this case, earnings of the firm or the cash flow of the firm or the sales of the firm to get an idea of where the price should be. Again, it's going to give you a basic idea of, a range, or not specifically a range, but a ballpark of where the price needs to be. Economic value add, on the other hand, is what we did was it is basically what you are earning minus the cost of equity. Economic value, this is the definition of it: return on equity minus the cost of equity. The difference between those multiplied by the invested capital, equity capital, will give you economic value add. And the market value of equity is nothing but the book value of equity. This is accounting book value taken from balance sheet. And the present value of all the economic value adds will give you market value of equity, which is another way to calculate the share price. And this is pretty much I want to cover or highlight for this chapter. So the important notion here is, again, the dividend discount model and how we calculate, how we are thinking about the value of a stock, using time value operations. And if you remember, we did time value of operations for bond valuation. We are doing a similar thing to value the stocks. The only difference is how we calculate, quote unquote, the discount rate or the required rate of return on a stock, which is pretty much covered in chapter 8. I hope this clarifies this chapter, and we are going to do a quick midterm review, and then we are going to have a midterm, and then after the midterm we are going to continue with chapters 10 and onward.